What if I told you the tax system was actually designed to make you wealthy, not keep you poor? Sounds backwards, right? But here's the truth nobody wants you to know. The tax code is an instruction manual written by Congress telling you exactly how to build wealth, and if you follow the instructions, the IRS will actually hand money back to you for doing it. Before you scroll past this thinking, it's another empty promise. Stay with me for the next 19 minutes, because by the end, you'll have 4 specific legal strategies that wealthy families have used for generations. This breakdown is based on the actual federal tax code and IRS guidance, explained in plain English for regular people. So you can decide what fits your situation and bring real questions to a licensed professional. If this sounds worth knowing, hit like, subscribe, and tell me in the comments what state you're watching from. Because as you'll see in a few minutes, where you live actually changes how some of this plays out. Most people believe taxes exist purely to fund the government, and that's true, but it's not the whole story. The deeper purpose of the tax code is to push Americans towards specific behavior Congress wants more of. The government needs businesses started, housing built, energy produced at home, and citizens saving for their own retirement. Rather than doing all of that itself, Congress wrote rules that reward you personally for doing it instead. Do these things, the code lets you keep more of your income, or hands you a credit outright. This isn't a theory or a loophole someone stumbled onto. It's literally how the system was built from the start. Nobody teaches this in school, most workplaces never mention it, and even plenty of accountants just file the forms. So most Americans spend their whole working life treating taxes as an unavoidable penalty for earning money, while a much smaller group, people who actually read the code, use it as a map to real wealth. The gap between those two groups was never about intelligence or luck. It's almost entirely about information. Today you're getting that information. Starting with 4 categories of investment, the IRS will quietly subsidize for you. The first is starting a business, and no, that doesn't mean quitting your job for some risky startup. A legitimate side hustle counts, even one bringing in a few $1,000s a year. And the moment it does, your entire financial picture shifts in a way a regular paycheck can never match. As an employee, you get paid, the government takes payroll and income tax off the top, and you live on what's left. You have almost no control over that order of operations. As a business owner, you get paid, you spend on legitimate expenses, and you're only taxed on what's left over, which means the order completely reverses in your favor. Equipment, software, so education, business travel, client meals, marketing, even a home office can all become deductions. And we're not talking small numbers here. Under Section 179 of the tax code, you can deduct up to $1 million of business equipment the same year you buy it. It doesn't matter whether that business is a sole proprietorship, an LLC, or an S-Corp. The IRS treats genuine business activity the same way, as long as you're actually trying to turn a profit and you keep clean, simple records of what you spent and why. Picture 2 people each making $80,000 a year. One is a W-2 employee and pays tax on the full $80,000, no way around it. The other runs that income through a business, spends $20,000 on a laptop, software, a work vehicle, and courses, and only pays tax on the $60,000 left over, saving roughly $4,000 to $7,000 depending on their bracket. Same income, same year, completely different tax bill, and it's all legal because Congress wants more people building businesses. It gets better if you have kids because you can hire them for real work they actually do in the business, shift income out of your higher bracket into their low or zero bracket, and they walk away having earned real savings. Congress wants more entrepreneurs and more job creation, so the code is written to make ownership pay better than employment alone. This isn't a gray area trick either. The IRS has clear rules for paying a child a reasonable wage for real work, and plenty of 6- and 7-figure business owners run this every single year without ever raising an eyebrow at an audit. Now, I know some of you are reading that thinking, that sounds great everywhere except where I live. One commenter from Hawaii put it perfectly. This all sounds easy, but Hawaii taxes and rents take everything anyway, so where's the upside? That's a fair pushback. And the honest answer is that federal deductions and state tax treatment are 2 separate systems. Section 179, depreciation, and the federal credits in this video apply no matter which state you're in, but how much you actually keep after that depends on your state income tax, local business taxes, and your rent or lease costs. In a high-cost state like Hawaii, a side business might save you less in net cash flow than the same business in Texas or Florida, but the federal savings are still real money you'd otherwise be sending to Washington regardless of your zip code. To be straight with you, I'm not a CPA and I don't know your specific numbers. Nobody giving you a YouTube video does. What I can tell you is which federal provisions exist, and your job is to take that list to a CPA who knows your state code. That's not a dodge. That's literally how this works for everyone who's actually built wealth this way. Now let's keep going, because business is only the first of 4 categories, and the next one might be even bigger. The second investment the IRS will pay you to make is real estate, And this is where the numbers start getting serious. Buy a rental property and you're not just collecting rent and building equity, you're unlocking depreciation, one of the most generous tools in the entire tax code. Here's the plain English version. The IRS assumes a residential building wears out over 27 and a half years, so it lets you deduct roughly 3.6% of the building's value every single year, even while the property keeps appreciating. Say you buy a $400,000 rental, with the land worth $100,000 and the building worth $300,000. You can deduct around $11,000 a year in depreciation alone. Meanwhile, your tenant's rent is paying down your mortgage, the property is likely appreciating in the background, and the IRS is letting you deduct an expense you never actually wrote a check for. Your rental might be breaking even or making a small profit in real cash flow, but on paper it shows a loss, and that paper loss offsets your other income and lowers your tax bill, while the actual property keeps climbing in value. If you want to accelerate this, a cost segregation study has an engineer break the property into individual components: appliances, carpet, landscaping, lighting, things that wear out faster than the building shell itself, and depreciate those over 5, 7, or 15 years instead of 27, front-loading much bigger deductions early on. Investors have used this to legally write off $100,000 or more in a single year from one property. Then there's the 1031 exchange, arguably the most generous rule in the entire code. Sell an investment property, roll the proceeds into another one inside the IRS timeline, and you owe zero capital gains tax. Not deferred, not reduced, zero. You can repeat that for decades, trading up property after property. And when you eventually pass it on, your heirs inherit it at a stepped-up basis that wipes out every dollar of gain you ever built. Some investors do this their entire working life, selling, exchanging, and upgrading every few years, and never once writing the IRS a capital gains check. This is how real estate dynasties get built, and it's completely legal, because Congress wants private citizens housing the country instead of the government doing it. If you're catching what I'm putting down, drop the comment telling me which of these two, business or real estate, you try first. Because business and real estate are only half of this. There are two more categories where the IRS doesn't just let you keep your own money. It hands you money you never had. And one of them is so generous it sounds almost illegal the first time you hear the actual numbers. Last time, I told you, the IRS has two more categories of investment that border on giving you free money. So let's get into the first one. Energy. The government wants America producing its own power. Oil, gas, solar, wind, all of it. So the incentives here are almost absurd. Invest in oil and gas through what's called a working interest, and you can deduct up to 70 or 80% of your investment in year one alone through something called intangible drilling costs, and it hits your return immediately, not spread out over years. Put $50,000 into a qualified project, and you could write off $35,000 to $40,000 against your income in year one. In a 30% bracket, that's over $10,000 back, and this is one of the only investments that offsets regular W-2 income directly. Congress carved out that exception specifically because they want private money flowing into American energy production, full stop. And because this counts as a working interest rather than a passive investment, the usual passive loss limits that block many real estate write-offs don't apply here at all. If fossil fuels aren't your thing, the renewable side pays just as well. The solar investment tax credit gives you 30% back, not a deduction, a dollar for dollar credit on your tax bill. Install a $40,000 solar system, and you get $12,000 straight off what you owe, while you still own the system and the power it produces. There are matching credits for wind, geothermal, energy storage, and electric vehicles, and the Inflation Reduction Act expanded most of them further. Most people have never heard a single one of these exists. While wealthy households have used energy investing as a core tax strategy for decades, the tax code is practically begging you to put money into energy, and most people just never learn the game exists. The fourth category is retirement accounts, and yes, you've heard of 401ks, but almost nobody uses them anywhere near their real limit. As a regular employee, you can put around $23,000 into a 401k. Solid, but small, compared to what's available the moment you have any business income at all, even on the side. Open a solo 401k and you can contribute up to $69,000 in a single year because you're funding it as both the employee and the employer at once, and every dollar lowers your taxable income. Make $150,000, max out a solo 401k at $69,000, and you're only taxed on $81,000, saving over $20,000 in a single year at a 30% rate. While that money keeps compounding as yours. Do that every year for 2 decades, and you've quietly built a multi-million-dollar advantage most people never knew was sitting there. But the real secret weapon almost nobody talks about is the health savings account, the HSA. It's the only account in the entire code with a triple tax benefit. Money goes in tax-free, it grows tax-free, and it comes out tax-free for medical expenses. No other account on earth does all three at once. Contribute the family maximum every year, starting in your 30s. Invest it instead of leaving it as cash. And by retirement, that account alone can be worth more than many people's entire 401k. A traditional IRA gives you 2 out of 3. A Roth gives you 2 out of 3. Only the HSA gives you all 3. Here's the move that changes everything. You don't have to spend it the moment a medical bill hits. Pay out of pocket, keep the receipt, and let the account grow for decades completely untouched. Then, in retirement, reimburse yourself tax-free for medical costs you covered 30 years earlier, after decades of tax-free compounding in between. It's basically a stealth retirement account with better tax treatment than anything else available to you. Now here's where the real wealth gets built, because these 4 categories stack with strategies most people have never even heard of. Opportunity zones let you take capital gains from anywhere, stocks, crypto, real estate, and roll them into a qualified fund to defer the tax. Hold that new investment for 10 years, and every dollar of gain on it comes out completely tax-free forever. Then there's the Augusta rule, named for the Georgia city that hosts the Masters, written into Section 280A of the Code. Rent out your own home for up to 14 days a year, and you owe 0 tax on that rental income, period. Run a business, rent your own home to it for meetings, pay yourself up to $2,000 a day, deduct it as a business expense, and personally collect up to $28,000 a year completely tax-free, and almost nobody uses this one. Qualified small business stock under Section 1202 is bigger still. Invest in or start a qualifying company, hold it 5 years, and you can exclude up to $10 million in gains from federal tax when you sell, which is why some founders pay almost nothing at exit. Compare that to a founder with no planning, who hands a 6 or 7-figure chunk of their exit straight to the IRS, simply because nobody told them Section 1202 existed before they incorporated. There's also a research and development credit worth up to 20% back. And it's not just for pharmaceutical giants. It covers software development, custom manufacturing, even a restaurant developing new recipes, as long as the work genuinely qualifies. High earners can use a backdoor Roth, contributing after tax to a traditional IRA and converting it to a Roth immediately, fully blessed by the IRS. And a mega backdoor version can push an extra $46,000 a year into that same tax-free bucket, if your employer plan allows it. Here's what it looks like, stacked, using someone making $200,000 a year as the example. Without any planning, they're handing over somewhere around $50,000 to $60,000 in federal and state tax. Now add a side business with a solo 401k contribution of $50,000, a rental property claiming $15,000 in depreciation, a solar credit worth $10,000, the Augusta rule worth $28,000 tax-free, and paying 2 kids $12,000 each for real work they actually do. That's over $100,000 in taxable income legally erased, plus a direct credit stacked on top of it. Their tax bill drops from around $55,000 to maybe $15,000, $40,000 back in their pocket every single year going forward. That's not a one-time refund. It's the same $40,000 showing up every single year, which means it compounds right alongside whatever you actually invested in. Compound that over 10 or 20 years, and you're not talking about a clever tax trick anymore. You're talking about how real wealth actually gets built. So here's the question I'll leave you with, and I actually want your honest answer in the comments. If the rules to keep tens of thousands of dollars a year are sitting right there in public, written into law on purpose, is it really the system holding most people back? Or is it the fact that nobody ever handed them the map? You can't unknow what you just learned, so the only real choice left is which one of these 4 categories you start with first. Business, real estate, energy, or retirement? Pick one. And tell me which one in the comments along with your state. Because the honest truth is the answer looks different depending on where you live, and I read every comment. If this saved you from leaving money on the table, subscribe now, because next time I'm breaking down exactly how to find a CPA who actually knows these strategies instead of just filing your forms. And that conversation alone could be worth more than this entire video. The tax code was never your enemy. It's a playbook Congress published in public, and the IRS is sitting there waiting to pay you. You just have to be the person who actually learned how to ask.